In 1944, as the smoke of World War II still hung over Europe, delegates from 44 nations converged on a quiet resort in Bretton Woods, New Hampshire. They sought to rebuild a shattered global economy, one that had been ravaged by depression and conflict. At the center of their vision stood the United States, holding 2/3 of the world's gold reserves, a symbol of unmatched financial strength. This gathering promised stability through a new monetary order, where currencies would anchor to something enduring. The dollar, backed by American gold, emerged as the cornerstone. Nations agreed. The U.S. would fix its currency to gold at $35 per ounce, a rate unchanged since 1934. This pledge seemed unbreakable, a foundation for post-war prosperity. Yet, beneath the optimism lay a subtle shift in power. Europe lay in ruins, Britain teetered on bankruptcy, and only America possessed the reserves to lead. The agreement wasn't just economic, it redistributed global influence, placing the dollar at the heart of trade and finance. What began as Reconstruction quietly crowned a new hegemon. Less than 3 decades later, the promise unraveled. In 1971, President Nixon severed the dollar's link to gold, closing the redemption window. The system built on metal now floated on air, but instead of chaos, the world adapted, clinging to the dollar as if nothing had changed. The gold vanished, yet the structure endured. How could a framework designed around gold survive its own abandonment? This paradox lies at the core of Bretton Woods. Nations pegged their currencies to the dollar, trusting its convertibility to gold. In practice, redemption was rare. Confidence in American stability mattered more. The system relied on illusion as much as metal. When foreign holdings of dollars swelled beyond U.S. gold stocks, the imbalance exposed the flaw. Countries could demand gold, but doing so risked destabilizing the very currency they needed for trade. Trust held the edifice together, a fragile balance where doubt could trigger collapse. Yet, most chose stability over redemption. The irony deepened as the U.S. exported dollars through deficits, fueling global growth. Surplus nations accumulated these IOUs, reinvesting them back into America. This cycle created dependency. The world needed dollars, and America provided them, gaining leverage in return. Gold's role faded, replaced by mutual obligation. In the end, the paradox revealed a hidden truth. Bretton Woods promised gold-backed certainty, but it engineered a system where promises sufficed. When the metal proved insufficient, trust didn't falter, it evolved, binding nations in a web of debt and interdependence. The dollar's reign persisted, unchallenged by its own contradictions. July 1944 marked the turning point. With Allied victory in sight, representatives from across the globe assembled amid the White Mountains. Led by figures like John Maynard Keynes for Britain and Harry Dexter White for the U.S., they debated for 3 weeks. Their goal: prevent the economic turmoil that had fueled the war. Europe's infrastructure was decimated, factories bombed, currencies Britain, once an empire, now owed billions. Its gold reserves depleted. The Soviet Union attended but observed warily, while smaller nations sought protection from future crises. Amid this desperation, America's position shone. It held vast gold stockpiles, accumulated through wartime neutrality and Lend-Lease programs. The conference forged the International Monetary Fund and World Bank, institutions to stabilize exchange rates and fund reconstruction. But the true innovation was the dollar's elevation. Nations agreed to fixed exchange rates, with the dollar as the pivot. This wasn't imposition, it reflected reality. America's economy boomed. Its gold vaults overflowed. Keynes advocated a neutral global currency, but White's plan prevailed, centering the dollar. This choice embedded U.S. influence into the system's architecture. As delegates signed the accords, they unknowingly planted the seeds of future tensions, where American prosperity would both sustain and strain the global order. Post-war recovery accelerated the shift. Marshall Plan aid flooded Europe with dollars. Rebuilding cities and industries, trade resumed, but on dollar terms: oil, commodities, everything priced in greenback. This dominance wasn't accidental, it stemmed from Bretton Woods' design, channeling economic flows through American banks. By the 1950s, the system hummed. Fixed rates minimized speculation, fostering growth. Yet, cracks appeared as U.S. spending abroad in military alliances, like NATO, increased dollar outflows. Foreign central banks held these as reserves, a vote of confidence in the dollar's gold backing. The balance held, but only hoost. The historical case underscores a deeper mechanism. Power follows reserves. America's gold hoard didn't just secure the dollar, it projected geopolitical control. Nations rebuilt under this umbrella, trading sovereignty for stability. Bretton Woods wasn't merely financial. It redrew the map of influence without a single shot fired. As the 1960s dawned, imbalances grew. French President de Gaulle, skeptical of U.S. overreach, began redeeming dollars for gold, draining Fort Knox. Others followed suit, exposing the gap between circulating dollars and available metal. The system, meant to endure, now teetered on the edge of its own logic. The economic mechanism began with a simple peg. The U.S. fixed the dollar to gold at $35 per ounce, a credible anchor given America's reserves. This convertibility assured the world that dollars held real value, not just paper promises. Nations trusted this link, building their systems around it. Step 2 unfolded as other currencies pegged to the dollar, creating a web of fixed exchange rates. Instead of each nation holding gold, they held dollars, easier to trade, more liquid. This efficiency streamlined global commerce, but it centralized risk. The entire structure depended on U.S. fiscal discipline. In Step 3, the dollar ascended as the reserve currency. Central banks stockpiled it for interventions, settlements, and safety. Trade invoiced in dollars amplified this role, making it indispensable. The system rewarded America with seigniorage, the profit from issuing the world's money. To meet global demand, Step 4 required U.S. trade deficits. America imported more than it exported, sending dollars overseas. This wasn't weakness. It supplied liquidity, greasing the wheels of international exchange. Foreign factories hummed, economies grew, all fueled by American consumption. Step 5 saw accumulation. Surplus countries like Germany and Japan amassed dollars. As reserves, they invested them in U.S. assets, recycling funds back. This loop sustained growth, but bred vulnerability to many dollars, to little gold. The mechanism thrived on expansion, yet sowed the seeds of imbalance. In theory, Step 6 allowed redemption. Any nation could swap dollars for gold. But practice diverged. Full conversion would deplete U.S. stocks. The system whispered a quiet revelation. It functioned not on metal, but on reluctance to test the limits. Confidence masked the shortfall. The reveal struck hearth architecture only endured while trust outweighed demands. When skepticism rose, the illusion cracked. Bretton Woods engineered stability through interdependence, but its core fragility lay in the gap between promise and reality. Power flowed to the issuer until the weight of issuance bent the frame. As dollars proliferated through U.S. military outposts and aid programs, the world became awash in greenback. By the late 1960s, foreign claims exceeded U.S. gold by billions. This excess wasn't error. It was the system's expansion, binding allies in a debt embrace that favored the creditor nation. In 1971, Nixon's announcement shattered the facade. The gold window closed. Convertibility ended. Inflation and deficits had eroded the peg. The collapse seemed inevitable, yet the dollar didn't fall. Nations, hooked on its liquidity, adapted to a fiat world. The irony burned. Gold's departure strengthened the system's hold. Today, echoes of Bretton Woods persist in the global reliance on dollar liquidity. Central banks stockpile U.S. Treasury bonds as the modern equivalent of gold reserves, safe assets that underpin their monetary policies. Trade imbalances continue, with the U.S. consuming more than it produces, exporting debt instruments in return. This dynamic sustains growth, but perpetuates dependencies, much like the post-war deficits. In place of gold shipments, settlements occur through digital transfers and bond purchases. Emerging economies accumulate dollars to stabilize their currencies, investing in treasuries that finance U.S. deficits. This recycling mechanism mirrors the old system, where surplus nations lend back to the issuer, maintaining balance through mutual obligation. Yet, it amplifies geopolitical leverage, as access to dollars can be weaponized in sanctions or diplomacy. The parallel deepens in persistent inequalities. Just as Bretton Woods favored the U.S., Today's structured channels wealth upward. Developing countries borrow in dollars, facing crises when rates rise. The reserve status grants America the exorbitant privilege, borrowing cheaply while others bear the costs. The logic endures power accrues to the provider of the world's currency. Digital innovations extend this reach. Cryptocurrencies challenge but often settle in dollars, reinforcing dominance. Global trade still prices essentials like oil and greenbacks. A petrodollar system born from the 1970s oil shocks. Imbalances settle not with metal, but with debt securities. A subtle transfer of risk from issuer to holder. The modern setup reveals a reframed understanding. Reserves aren't about scarcity anymore, but abundance. Treasuries flood markets, absorbed by foreign investors seeking safety. This flood sustains U.S. spending wars, entitlements while binding allies in financial webs. The parallel warns: dependencies deepen, vulnerabilities linger. Money is rarely what it claims to be. At Bretton Woods, gold promised immutable stability, a hedge against human folly. Yet the system hinged on faith in one nation's stewardship, a political compact disguised as economic law. When the metal receded, the structure didn't crumble, it exposed the truth. Value arises from agreement, not atoms. This insight reframes global finance as a theater of trust. Debts between nations mask class transfers, where elites orchestrate flows to preserve control. The illusion of backing gold then, bonds now sustains the play, but doubt can shatter the stage. Power isn't held. It's lent, repaid in loyalty. The philosophical core lies in this. Evolution systems claim natural foundations, but they rest on fragile consensuses. Bretton Woods didn't fail, it succeeded in normalizing fiat, proving that confidence can outlast substance. In a world of illusions, the most potent currency is the one we collectively pretend is real. History whispers an ominous lesson. Balances tip when trust erodes. Today's dollar hegemony mirrors the old gold peg, robust until challenged. The conclusion. Economic architectures are political inventions, shaped by incentives, sustained by inertia. They collapse, not from weakness, but from revelations of their own artifice. When that promise replaced the metal, the system didn't collapse, it simply revealed what had been true all along. Global money is a political agreement, not a natural law. Bretton Woods didn't just replace gold with the dollar, it replaced metal with trust, and trust became the most powerful currency on earth. If this glimpse into the hidden mechanics of global finance resonated with you, hit that like button and subscribe for more breakdowns of the systems shaping our world. Share your thoughts in the comments. How do you see trust playing out in today's economy? For deeper dives into economic history and power structures, check out our playlist on monetary illusions. Your support keeps these insights coming. Thank you for watching.